Fresh inflation data from the States this morning, cementing worries that the Fed will not cut as much this year as previously hoped. We've had 3 straight months of pretty strong, pretty high inflation data. The Fed's path towards 2% inflation looks to be stalling. Our guest says we have a long way to go to get inflation into the range needed for rate cuts this summer. We're joined by Andrew Brenner, head of international fixed income at NatAlliance Securities. Andrew, great to talk to you. Is Jay Powell, is his hair going grayer all the time? Is he disappointed with this inflation data?
There's no question he's very disappointed. Jay Powell really wants to ease rates, but he can't find the cover of which to do so or the rationale of which to do so. And today's number just didn't help. The PCE number, we had heard rumors that it was going to be a whisper number about a tenth higher than expected, and that's exactly where it came in. And while we did rally a bit today, that is more of a reason because of the huge shorts that are out there. And we had a very kind of a dead cat bounce rally today in rates, but it did sustain itself. We think next week when Powell speaks in front of the world, we think he's going to pivot and be a little bit more hawkish than he's been in the past. And I think that's where the shorts hope to get a move back to higher rates, higher yields, and cover their shorts.
You mean shorts in the fixed income market or in equities?
Yes. No. Shorts in the fixed income market. Equities is a totally different story. There you've got CTAs. You know, you've seen, I'm sure you've talked all day about Microsoft and Google and the great earnings and so on and so forth. You know, we're a little hesitant about equities, but we really follow the fixed income market very closely. And as much as I hate to say it, I think fixed income rates are going to go higher. This week we got to 502 2 years, 475 5 years, and 473 10 years. And while you closed off those levels today, we think those levels will be exceeded next week as the fear of what the Fed is going to do or not going to do starts to make its way even more through the marketplace.
Let's have a look at the U.S. 10-year bond yield over the past 1 year or 5 years. Is there a chance we get back up to the October highs?
If we can close above 480 on 10 years, I would say we're a hop, skip, and a jump back to 502, where we were back in October. I see very similar things setting up now. Again, we really do think the inflation numbers are going to come down, but we have no justification. We have no backing of that right now. I mean, we look at a lot of forward-looking things, and inflation, especially CPI, looks at a lot of backward-looking things, meaning owner's equivalent rent or things like that. But we think that we haven't shaken out all the longs yet, and higher rates could come before we end up going to lower rates, which eventually we will go.
What should bond investors be doing right now? Just avoiding long duration?
Absolutely. You know, I mean, as much as I've thought about the idea of buying 5 years or 10 years or 30 years or what have you, I've had all of our client base stay in Treasury bills. You know, it's pretty hard to give up 535 to 540 yields and to extend duration risk and give up 75 to 100 basis points. So we've been in bills all year, and consequently we have very good returns because of it. It's you know, a pretty risk-off strategy. But, you know, when the Fed has interest rates, short rates this high, you might as well buy the thing that yields the most, and it's the safest.